So with every year, the budget speech does obviously have a great impact on the business sector as a whole and the property sector as well, especially when it comes to property investors and people that are speculative in the purchasing of properties, developers, people, simply, trying to start up businesses like Airbnbs, hotels, or just providing normal accommodation, whether it's affordable accommodation or standard accommodation. Now, the budget, maybe just for a bit of background, the budget is simply a proposal that's put forward by government first, and that still needs to be promulgated and passed through Parliament. So it's a budget. It's so the country understands why certain proposals are being made, and then it goes through the rigorous process of being approved by Parliament. So this year, the talking points in the budget. Now, obviously, everyone needs to bear in mind that there are many talking points. There are many consequences, both in law and tax, that this budget addresses. And some of them don't impact you directly. It would impact you indirectly, for example. And we're not going to be focusing on those today. So our primary focus is going to be in the business landscape, very much within the property space, but also the landscape of any business, especially small to medium-sized enterprises. Now, the first big one is the VAT increase. Now, I think that everyone took a sigh of relief after the initial suggestion had been made that there'd be a 2% hike in the VAT rate. I think most people were far less shocked or appalled by the fact that now it's only a 0.5% to take effect from this year, and another 0.5% that will take effect in 2026. So this means by next year, April 2026, there is going to be basically a 1% increase, which is still half of what had been proposed in February, which I suppose, does offer a sigh of relief, although I do see that there's a lot of political pressure still in place regarding this increase. And from the sounds of it, there is going to be some opposition in the passing of this increase through Parliament. So again, as it stands at the moment, this is still speculative. And although most role players and stakeholders expect this increase to be implemented, it is still something that needs to be passed and approved prior to implementation. So if you have a business, if you charge VAT, I would strongly, strongly recommend that you start looking into your systems right now and start looking at what it will take to update your systems. Now, everyone's going to ask me, what does the VAT increase have to do with property investors? Now, as a supplier, for example, having this conversation is meaningless in the sense that now you understand that you're going to need to charge 16% VAT at some point next year, 16% VAT on the supply of your products. Cool, great. But in the property space, what does this mean? So residential property, as everyone knows, is exempt from VAT. So if you provide a long-term residential accommodation, you do not charge VAT. It is exempt. Now that may sound like great news, because it means that now you don't need to worry about the VAT increase because it won't impact you. Unfortunately, please remember that VAT works both ways. So you're not going to have to charge VAT, which means that your prices might remain the same, but the costs of everything in association with that property. So, for example, whether it's repairs, whether it's maintenance, whether it's certain services, these all carry a VAT consequence. So, unfortunately, you as a property owner don't charge VAT, but you also can't claim input tax. And what that basically means is if you're supplying a VAT service and you're paying VAT, you can claim that VAT back, but not in residential property. So please understand that there is an impact. It might not be direct in the way that you invoice, but it does still impact your bottom line because your costs are now going to be a lot higher. Now, when it comes to VAT, for example, the one converse that the property sector understands very well is when you buy and sell properties, it's either a VAT transaction or a transfer duty transaction. And so now that we've spoken about VAT a little bit, is there a consequence when it comes to transfer duty? And yes, there is. So transfer duty, it has increased the threshold by 10%. So the VAT increase will have many, many, many indirect consequences, because now there's VAT along a long line of services and products, and people in many sectors are obviously going to feel the impact of this increase. It's not just going to be a direct cost that you're paying today. It is obviously going to accumulate over time. But as a property investor, as I mentioned, the one direct consequence is that your suppliers now to your properties, having bought the property already, your suppliers will now be charging more, so now you'll have to pay more for whatever you need. Now, if we're speaking about buying property, again, it goes back to what I'd said earlier. So residential property is exempt from VAT. So buying a residential property, strictly speaking, will carry the same cost because you don't need to pay VAT. You'd pay transfer duty, which is a separate conversation that we'll have just now. So because you're not paying VAT, you're not necessarily paying that extra 1%, unless, for example, you're buying a residential property from a property developer, in which case there is a VAT component to it, or you're buying something that we call commercial accommodation, where it's similar to things like student accommodation. Student accommodation people don't charge VAT on, but things like hotels and Airbnbs, they do charge VAT on. So where the accommodation is more commercial in nature, you may very well find that, unfortunately, now if you're buying it, and the supply, and you're buying it as a supply, you may have to pay a higher amount of VAT. But on the flip side, bear in mind that if you're paying VAT, you get to claim input tax back. And many of those transactions you can actually zero rate because it's going to have the same effect. You're going to be paying VAT, but you're going to be charging VAT. So you would be allowed to zero rate so that that transaction goes through without any VAT consequences. Now, from an affordability perspective, if you're looking purely at the financing side, whether it's home loan financing, corporate financing, commercial property financing, does this impact your affordability? Now, in the home loan financing, it may very well impact your affordability, but also depends what your expenses are. Because bear in mind that 15 to 16% is 1%. In total, in the economy, I believe it's around 8 billion rand worth of taxes. So it's a very, very high amount. But in the consumer's pocket, you have to remember that it's basically for every 1,000 rand, you would be, if I'm not mistaken, it's 10 rand. So for every 100 rand, it would be 1 rand worth, right? So you just do this calculation and you would see whether that 1%, it's very easy to budget for this because it's 1%. So you would be able to budget and try and do the calculation in future to be able to ascertain if your expenses, if all of them went up by 1%, would this deeply impact your affordability? Now, for most consumers, unfortunately, that is the case. I mean, they're already struggling now at the moment as is. So to expect anyone to pay even 1 cent extra is terrifying for them. But it is something that can be budgeted and understood. And I think 1% direct taxation in the individual's hands may not be that substantial to impact their affordability. But yes, unfortunately, we are yet to see how this will play out. I'm not terribly sure that the VAT increase will impact the property space so directly that we'll notice. It's not like interest rates, for example, where you see the interest rates on such high amounts and such high loans that it deeply impacts the property market, and you can see that investors and buyers are struggling to buy properties. And again, other factors also play a part. So the value of the property is going up is also something to consider. So if you look at your Cape Towns, for example, and you look at the property market there, it does differ from the rest of the country. If the costs of construction of a property, for example, people are going to increase because now there's extra VAT that needs to be paid, and these are high amounts that you're talking about, you may very well find that there will be a connection between the VAT increase and the value of a property, meaning that a person would have to fork out more money at the end of the day in order to buy a property. So I'm not denying this fact. It may very well come to play. Remember, I'm not an economist, so this is all purely speculative, that one will carry on to the other. And that's what I mentioned earlier on. Unfortunately, there is this unseen correlation where one expense on the one side will inevitably, indirectly, lead to further expenses or a higher cost on the other side. The rule of thumb is, unless it's a VATable supply, if a person is selling fixed property, so land, there will be a transfer duty payable, which is a tax. So in the sale and transfer of property, fixed property, there will be a tax payable unless VAT is payable on the transaction. VAT would be payable in the transaction, for example, if the seller's VAT registered and the property is used to make VATable supplies. So, for example, if it so happens that you sell a piece of land with a hotel on it and you sell it to a buyer, the seller would have to have VAT factored into the purchase price when selling that hotel. However, if you're selling residential property, which I mentioned earlier is exempt from VAT. So when you charge rent to your tenants that live on your property long term, no VAT can be charged. You're not allowed to charge VAT. It's an exempt supply, which means that when you sell that property, you're not going to charge VAT on that transaction. But there is still a tax that is going to be payable, and that tax is called transfer duty. And that's basically it. So it's just a tax for the transfer of a property. Now, fortunately for us, one of the pieces of good news is that transfer duty, the threshold for transfer duty has increased. Now that's good, because the higher the threshold, so 1.21 million rand, anything below that, you don't need to worry about transfer duty. So it went up from 1.1 to 1.21, which basically means that if you own properties below that threshold, you don't need to worry about transfer duty. And even if you own properties above that threshold, because the threshold work in tiers, it means that now it's been adjusted by the 10%, meaning that you as a property seller, obviously now you're going to market, and usually it's the buyer that pays the transfer duty, but you as a seller can now benefit from the fact that if you go to market with a property under 1.21, that the buyers may not need to fork out this transfer duty, which is often a hindrance. And we do find it in practice where people buy properties, they might even qualify for a bond over the purchase price, only to find out later that there's massive costs associated with buying a property that they need to now fund, and they don't have the cash to fund it. And many deals fall through because of that. So how does this help property sellers? Tremendously, because as a seller, you actually want your purchaser not to be financially constrained. As a purchaser and an investor, obviously it helps because now you're paying a lot less than you would in the past. Obviously, again, it's only a 10% increase in the threshold. So how impactful will this be? It's difficult to say. I wouldn't say that this is going to rock the property sector, but it definitely does offer some form of relief.